Hello, everyone. It's Jeremy Felt from Harvest Realty. Today's video, we're looking at financing. So again, one of the most important things is we want to buy a home, but how are we going to go about doing that? So financing, understanding kind of some of the big picture and some of the detailed items is very, very important. So in the contract to buy and sell are different items 13 through 21. Those deal with loan and credit. So again, a lot of times we just think of, cash or conventional or maybe FHA loans, but there's a lot of other ways that we can finance a property depending on the situation. Some more creative financing options may be the route that we need to go. So first, we have the new loan application deadline. If we know we need to get a loan, hopefully before we've even seen properties, we've met with a lender, we've got them bank statements, pay stubs, different things that they need to just kind of do their background check, so to speak, to make sure that you're going to even qualify for a loan. Now, pre-approval doesn't automatically mean that you're going to get a loan because there's some other things that they'll need once you go under contract. So once we go under contract, we get the contract over to whoever our lender is, and that is the new loan application. So just having pre-approval, we don't put that it's completed, that we've already applied for the loan. Technically, that happens after mutual execution of the contract. The new loan terms deadline, that's something we need to think about, buyer and seller. How long do we want to have in order to review the terms of the loan? And if I'm a seller and it's a 30-day close and they want 29 days to figure out if the terms are acceptable to them, I don't feel comfortable with that. Okay. If I'm a buyer and I only have 1 day to review the loan terms once we go under contract, I don't really feel comfortable with that either. So finding somewhere in between that obviously everyone will agree upon, but it's important to understand those loan terms, that gives the buyer the ability to terminate, as the language is throughout the contract, at the buyer's sole subjective discretion. That means they don't have to give any sort of reason as to why they're using this to terminate the contract. They don't have to say the loan terms and then give some documentation of, the rate went up from this percent to this percent, and that's going to raise the mortgage from this to this, and we cannot are not able to pay that because of these reasons. You don't have to do any of that as a buyer. Just say, terminate. Here's the reason why. You check that box, send it over to the seller, and it's terminated. So that buyer's sole subjective discretion. Contracts are very buyer friendly in Colorado. It's really difficult for a seller to ever keep earnest money. So being aware of that is hugely important because if they have the ability to get out, when are we comfortable with that window being? Loan availability deadline, we need to figure out if the buyer is even going to get the loan. How long is that going to take? Are we going to give them a week, 2 weeks? Are we going to give them a month? That's something that you need to discuss and figure out and be okay with. Again, I think a lender should know pretty early on in the process if, hey, it's looking like this loan is going to work and be available, or it's not going to be. How long are we going to give that? If there's any sort of seller financing, like they're doing an owner carry, maybe they own the property free and clear and they're going to act as the bank, and the buyer is going to pay them directly in the form of a loan. They probably want to see the buyer's credit information. And then they will have the ability to terminate off of that if you get the buyer's credit history and realize, their credit's awful, their financial history is a disaster. They're never going to be able to pay us this loan back. Just like a lender or a bank, they do their due diligence to make sure that this borrower is qualified. An owner providing seller financing is going to want to do the same thing. Is there any existing loans on the property that are going to be taken over? Can they review that, terminate that? If it's just a new loan, don't need to put anything in there for the dates and deadlines. So if there's an existing loan or a loan transfer, anything being assumed, okay, that you need to put in a deadline for that. When is that going to take place? And then is there any seller or private financing? Maybe it's an investment property and you have some hard money lenders or people that are going to invest the money in you. You need to disclose that and obviously make deadlines for everything. The new loan, again, what loan type is it going to be? Is it going to be conventional? which is a really good loan program. It's requires a little bit more down payment, but if you're able to, you could possibly get a lower rate. Putting a percent, if you're able to put up to 20% down, it's likely that you can drop the private mortgage insurance, which will save you, every month and not having to pay that. So it's a good loan type. FHA is good. It's a government loan like the VA loan. So there's a few more hoops that you may have to jump through. The nice thing about FHA loans is if you have not great credit, sometimes you can qualify for those loan types as opposed to a conventional. So FHA buyers, but again, the condition of the property needs to be in a little bit better shape than a typical conventional loan. So if there's exposed flooring, peeling paint, broken window sills, different things like that, those may need to be addressed before the loan can get approved. Is it a VA loan, or is it the buyer a veteran? Are they going to look at the VA loan? A nice thing about that is it's no down payment. It's 100% loan value. So if you're buying a $400,000 home, you can get a $400,000 loan if you qualify for the VA. Is there a bond? Is there other? In Colorado, we have a nice loan program that's known as CHAFA. It's down payment assistance. You pay $1,000 down payment versus the 3% or 10% or whatever the case may be. And then that gets tacked on as a silent second mortgage on top of the FHA loan. So again, really kind of a nice, sometimes that's cheaper than even a rent deposit, $1,000. It's a nice way to get into a home and get paying towards your own mortgage and your own property. That can be a nice option. Also, there's USDA loans, rural development loans. If it's in a smaller area, that may be available. My first home purchase was a rural development loan, and we didn't have much money for a down payment. We didn't have any money for a down payment, so we got a 100% loan on the property, which was really nice and saved us some money. They can be a government loan, so it could be more hoops to jump through. Could be take a little bit longer to get through the process, so just be aware of that. Financing conditions in the contract, again, it follows the same pattern. You can review things, and then in this case, we wouldn't really object because there's nothing the seller can do to help, but we can review and then terminate on or before those deadlines that we've put in place in the contract. So loan terms, again, rates, interest, principal, all of those different things. What's the mortgage going to be every month? Oh, we thought it was going to be $2,000, it's really going to be $2,700. Those terms are not acceptable to us, so we need to terminate. So that's in the new loan terms. The new loan availability is if the loan is even going to be available to the prospective buyer. Can they even get the FHA or the conventional loan? Again, how long are we going to allow in the contract for that to take place in those dates and deadlines? The Section 5, that references back to these items. If it's a cash offer, the nice thing is we don't even have to worry about this, and a lot of times we'll just remove it from the contract, so we don't have to read through it because it doesn't even apply. And then which loan is right for you? So you're a buyer, you're looking at purchasing a home. Well, which route makes the most sense for you? What property type are you buying? That may affect it as well. If you're looking at buying a manufactured home, that may limit your loan options. Whereas if it's just a site-built home that no issues and things like that, you may be have multiple loan options available. So conventionals we talked about. Lower interest rate, you bring more down to closing. A lot of times you're able to avoid the mortgage insurance if you bring enough to closing. Not everyone always has that big percentage to bring, which is okay. But again, that conventional loan is really solid, not a lot of hoops to jump through. Makes the appraisal process a little bit easier as far as the conditions. FHA, if you have lower credit score, this one might be a good option for you. It's flexible. It's a little bit more forgiving than conventional, but it has a few more requirements of the condition of the property than a conventional loan. So that might be a good option for you. The USDA, the rural development loan, those are really good. You live in a small town or an area that it's still available for. You can't go anywhere. You can't obviously go to Denver, Colorado and think you're going to get a rural development loan because that's metropolitan area, it's not going to work out there. So it's not available everywhere, but certain areas it is, and your lender will be able to help you with mapping that out. We're interested in this area of town, or we're interested in this city or this region of Colorado. Is it available? And they'll be able to tell you yes or no. Again, no down payments. You can get 100% loan value. That's really nice. Again, government loan, so it could take a little bit longer. There could be a little bit more requirements and hoops to jump through. But again, good option if it's available. VA loan, if you're a veteran, that's a requirement. Flexible credit guidelines, and again, no down payment. So you can have up to 100% loan, buying $300,000 home with a $300,000 loan. That's really nice for a lot of times when people don't have that 3, 5, whatever percent to put down at closing. That's a nice option for you. So doing your research, talking with the lender, obviously they're going to be your go-to person as far as the expert in this field. That's where I would start. Again, getting creative. A lot of times people think, oh, we can't get this loan, so we can't buy a home. And that's not always the case. Or we don't have, $20,000 or $40,000 or whatever the case may be to put down at closing. We can't get a loan. A lot of times people give up before they even start, when in reality, there are some ways that you can work around, get creative with financing, and find something that works for you. So doing your due diligence along with the professionals alongside you is going to get you where you need to go. Thanks, you guys. Hope you have a good day. We'll talk to you soon.